This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 373 was produced on April 27th, 2023. I'm Eric Townsend. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Saxo Bank's chief commodities strategist, Ole Hansen, returns as this week's feature interview guest. Ole and I will discuss the broader commodities bull market and the role interest rates play in contango and backwardation. Then we'll drill down on specific commodities, including crude oil, gold, copper, grains, and more.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, April 26, 2023. The S&P 500 was down 2.4%, closing at 4,076. We'll take a closer look at that chart and the key technical levels to watch in the post-game segment. The U.S. dollar index is down 0.1%, closing at 101.84. Continues to show weakness, but will those central bank statements next week change that? The June WTI crude oil contract down 6.2%, closing at 74.30. Deep reversion of its recent strength. We'll look at that chart, and Eric will have the EIA inventory data in that post-game segment. Gold down 0.5%, closing at 1996. Stalled on the week-over-week advance, but the bull trend remains intact. Copper down 5.6%, closing at 385. Significant technical weakness there. Uranium up 1.8%, closing at 52.10, attempting a bull breakout. The U.S. 10-year Treasury yield down 14 basis points, closing at 345 points. And the key news to watch on Friday is the release of the PCE price index and a news pack week next week with the U.S. ISM numbers, the FOMC statement, the EU monetary policy statement, and the Friday jobs numbers. This week's feature interview guest is Saxo Bank Chief Commodities Strategist Ole Hansen. Eric, why did we get Ole back on the show this week?
Well, Patrick, Ole is an extremely well-respected commodities strategist, and my own investment outlook is I think that the long-awaited recession is finally going to hit the stage sometime this year, and the depths of that recession are going to mark a generational buying opportunity in copper, uranium, and crude oil. Now, I misspoke in the interview with Ole. I think I said copper, uranium, and gold. I meant to say copper, uranium, and crude oil. My expectation, as confirmed by quite a few of our feature interview guests in recent weeks, is that we are eventually headed toward new lower lows in the stock market, probably around 3,000 on the S&P. And so I'm basically making a shopping list for when we get there. What am I going to buy? I'm very cash heavy right now and holding on to plenty of cash, getting ready to make the big buy at the depths of the coming recession. So I want to pass my strategy past Ole, get his feedback, find out what Saxo's outlook is, and see what I should put in that shopping list in addition to copper, uranium, and crude oil, so that I know what to buy at the bottom, which I think is coming sometime late this year or very early next year. Just a quick production note before we dive into the interview. This was recorded on Tuesday before the OPEC Plus gap on the crude oil price chart was filled in by a sharp move lower in price into Wednesday's closing bell. So in this interview, Ole and I are going to postulate what might happen, whether or not the OPEC gap will be filled. When it does get filled, will the market immediately rebound to the upside, or will that be just a dead cat and end up trading lower still? Needless to say, we already got our answer pretty darn clearly on that on Wednesday after the gap filled, and then the market moved more than a full dollar lower than the gap fill price by the close on Wednesday afternoon. So just keep that in mind that the market has changed a little bit since this was recorded.
Eric's interview with Ole Hansen is coming up as MacroVoices continues right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Ole Hansen, head of commodities research for Saxo Bank. Ole has prepared a slide deck to accompany this interview that you're not going to want to miss, so I highly recommend that you download it and refer to it as we will be discussing the charts and graphs it contains throughout the interview. Ole, it's been way too long since we've had you on MacroVoices. Welcome back, and why don't we dive right into the slide deck and talk about U.S. interest rates, because so much else hinges on that. What's the outlook?
Oh gosh, I wish I knew, Eric, and thank you very much for inviting me back. It's most certainly still a market that's throwing up a lot of surprises and talking points. But yes, the direction of interest rates, short-term interest rates in the U.S. has clearly been a major focus in the market over the past 6 weeks, going from expecting a year of no change in terms of rate cuts and further hikes to suddenly a dramatic round of cuts in response to the banking crisis, and now since then the market that's once again, just basically looking for hikes in the short term and cuts in late in the year, and that's really, I think, creating a lot of confusion in the market and also uncertainty, and it's still it's amazing how resilient some of these markets have been. I would say especially the stock markets, even though it's not my area of competence, but I think we've seen quite a stable market there despite all the uncertainty that's out there.
Let's talk about inflation and where it's headed. A lot of people seem to think, okay, it was all about the pandemic and supply chains, and that's behind us now, and we're headed back down to 2%. I say no way. I think we've got a new secular inflation trend that's going to stay with us for a long time. What's your outlook, and how do you see this developing?
Well, that's exactly one of the reason that as well we look toward the commodity sector as a place of investment interest because we highly doubt that the long-term inflation that the market is currently pricing in around 2.5%, that it can be met. We will see the base effect of last year's very high prices still have a positive impact, downward impact on inflation in the coming months. But then we see things start to turn higher again, and the structural inflation over time perhaps more closer towards the 3 or even the 4% area, and that will obviously have a significant impact on markets and potentially at one point lead to some repricing as well.
Well, let's expand on that outlook a little bit and move on to page 3, where you talk about the continued upside potential for commodities. Obviously, inflation and interest rates are part of this, but there's, I think, a bigger picture here. Is this being driven by interest rates and inflation and so forth? Is it being driven by energy transition and the expected need for copper in order to, electrify the vehicle fleet? Is it being driven by something else? What is actually going on that's obviously been a change in the market? What's driving all of this?
Well, it is a combination of all of the above you mentioned, and as you can see on slide 3, there's quite a lot of text there. But it's just some of the major developments that we've seen over the past year. The war in Ukraine has kick-started a unfortunate route in the market where we're looking at deglobalization, reshoring, friendshoring. These developments are likely to push up price for key commodities. The green transformation, we all know, it's supporting demand for industrial metals at a time where investments may potentially not be strong enough, where supply of key commodities or key metals in the coming years could be challenged simply by the fact that the cost of production going up, quality of the ores are coming down, and multiple other factors that could have an impact. So that will also be adding upward pressure to the price. And basically, I think the thesis is that the key commodities will potentially will thrive, even though we may have an economic slowdown where demand may suffer. The supply side is equally challenged as well in our view. And this whole deglobalization, we call it the fragmentation game. We put that out in our quarterly outlook recently, and our equity guy is basically using the fragmentation focus to basically to highlight some sectors in the stock market. We should not talk about that now. That's not my area of competence again. But just look at these. We can see how defense already has been benefiting the European defense stock. We got electricity, renewables, and nuclear power. We got technology. We got commodities. These are all sectors we call them the 4 pillars in equities that we are looking towards for as investment themes over the coming period. But adding to all this, we also have these de-dollarization, even though we don't really believe it's going to be having a strong impact. The weaker dollar is something that we are focusing on as well, simply as rates are starting to eventually peak out in the US, and we'll continue to see rates move higher elsewhere. Also a reason why we've seen the euro do reasonably well this week, briefly back above 110 again, and the weaker dollar we know is supportive for the commodity market in general.
Ole, we live in interesting times, to say the very least. Let's talk about the trade relationship with China and how it might evolve in the next few years. Obviously, neither one of us has a crystal ball, but we can look at the geopolitical landscape and easily ascertain that there's much higher risk of a breakdown in relations between the United States and China in coming years than there has been in prior years. What would that mean in terms of the commodity world? Let's imagine that there's, I don't know if it's quite a declaration of war between China and the United States, but let's say things are moving in that direction and there's a complete breakdown of trade. What would that mean to the global commodity market, and what would it mean for the world?
Well, it would mean that I would say in Europe especially, but also elsewhere, we are in a hurry to reshore some production and go and look for key commodities elsewhere. And overall, I believe it will drive prices higher. We know how our dependence on something like rare earth minerals, how that potentially could play out. So it's difficult to envisage a complete breakdown, because we have built up a dependency on each other from a trade perspective for the past 2 decades. And with that in mind, I believe we'll find some kind of equilibrium sooner or later, before obviously it goes completely pear-shaped. But what we're seeing in terms of commodities right now in China as well is that the recovery we're seeing is a recovery, but it's just not as commodity intensive as we've seen in previous recoveries. And then that's also a reason why we're seeing some of these commodities right now being under pressure. We're seeing iron ore drop back down to $100. We're seeing steel production in China starting to slope. It's simply because they're not using all the government handouts on property, building new cities. They're thinking differently this time. But again, the green transformation is still part of the major solution, and also a major focus in China. And that basically means that some of the commodities that are involved in that sector will continue to thrive. But it's creating a lot of uncertainty, and global supply chains needs to be reconfigured, and that whole process is difficult to see that without adding upward pressure to prices.
Moving on to slide 4, we talked about China just a minute ago, but let's expand on that a little more. So many people, myself included, thought that the reopening of China's economy was going to be the big floodgate that would really unleash a lot of inflation, a lot of commodity inflation particularly, and a lot of economic demand. And, you know, the economic recovery of China is underway. It's happening just like we predicted it would. But boy, the commodity impact hasn't been there. How do you explain that? I mean, we really thought that as soon as China picked up, there wasn't going to be enough oil supply. Prices were headed much higher. None of it's happened yet.
No, and I think the initial reaction or the initial movements, activity seen in China is that people are looking at consumers are looking at the service economy. They're looking at it's not a consumer demand driven recovery as we've seen before, simply because you haven't been able to go out to restaurants and to travel and do things that may not necessarily be as commodity intensive as we saw during the lockdown period where we all went on a spending spree for consumer goods, and that helped drive the big start to the rally in the market. So it's more even out, and it's the focus is simply somewhere on in terms of how the growth is being created, and that's probably caught the market by surprise because according to the rule book, when China adds stimulus, it's good for commodities, and at least that's what we saw on several occasions during the past decade. This time round, as we come to realize, is different, and some producers have been revving up production in anticipation to meet that stronger demand. And as it's not materializing at this point, it's just having a negative impact on some of the markets. And I think happening at the same time where we're still in doubt about the strength of the slowdown we're seeing elsewhere, then let's just add to the uncertainty. And from a macroeconomic perspective, trading it's something that means that you are becoming a bit more cautious on the at least on the short-term outlook.
Ole, moving on to page 5, I want to just alert our listeners that these charts are not just for today. You can actually get updates every single week at analyses.saxo, something that I am definitely addicted to. For listeners who may not be familiar with commodity charts, talk to us about this. And it's not quite red, white, and blue. It's kind of red, yellow, and blue, where we have these blue and red shaded areas, but then there's a yellow line that's really the important one on top of everything. What do these charts mean with the blue on the top and the red on the bottom and the yellow? Explain the chart first, and then let's walk through them.
Exactly. Well, these are basically data that we pull from the CFTC on the weekly basis, where the positions held in the futures markets, especially in the US, but also some of the European ones, Brent, gas oil, and so on. They have you have as an investor have to report back to the exchange what you hold in terms of positioning. I think in commodities it's a great tool simply because all the activity that we see in commodities, they tend to end up in the futures market. There are similar reports for stocks and bonds and currencies as well, but they're all part of a major cash market as well, where it's very difficult really to gauge too much into it. But looking at the futures market as a cake, that cake has to be can be cut into slices. Or the cake is basically the open interest, and we cut that into slices. And the slice that we're focusing on is the managed money section, simply because money managers, hedge fund speculators, they have a lot of different names. What they do is that they are looking for direction. They're looking for momentum. They are not married to their position. So they will continue to buy into strength, sell into weakness until the technical or the fundamental outlook tells them that they're on the having a wrong position. And then obviously they're very quickly to respond. And that basically means on a weekly basis, we get a snapshot of the positioning in the market, how the changes has been. And it quite often it helps explain some of the volatility that we are seeing in the market. And quite often we just focus on what we call what is the yellow line here on the slide, which is the net position. But it's equally important to know how is that position built from the number of longs and the number of short. Because if you have a market where the long has been created with a very, very limited participation on the short side, then you obviously have a problem if the market turns around, because if these longs need to get out fairly quickly and the short position is relatively small, then who's going to buy them? Because the other side of the coin quite often are producers and hedgers, and they don't necessarily have the need to go in and buy a market that's falling because they've been hedging some forward production. So that's why I think it gives a very good idea about how the market is behaving, and we can see some of the recent movements starting with crude oil. I think there's a slide a bit later on, but oh boy, that's just been a horrendous 6-week period. We had a technical break to the downside when we broke below 80 in Brent, and that attracted a lot of momentum selling. And within within a couple of weeks, we had the OPEC production cut, and they were all forced to cover shorts and enter back into longs, and that's creating some pretty unwanted volatility. But if you look across some of the others, you can see the interest for gold is very high. The agricultural space is a bit mixed. I didn't put in wheat, but that's actually the most shorted of all the commodity futures that's currently around. So that just highlights how the wheat has fallen from grace since hitting some hitting pretty record highs last year. And something like copper as well, even though the market wants to be bullish, the net position is relatively small, simply because the chart right now is not really giving any clear direction, whereas gold for quite a few weeks has been given quite a clear buy signal.
Ole, let's move on to slide 6, which is about backwardation and contango. And just as a quick refresher for, I think most of our audience is already familiar with the terminology, but backwardation and contango. Let's start with, what do these phrases mean, and what are these charts telling us about them?
Well, backwardation is simply the shape of the futures curve. If you have a futures curve that's in backwardation, that basically means that you're paying the highest price in the spot market. The first contract is trading at a higher price than the following contracts. That is an indication that you as a buyer are pretty anxious to get hold of your get delivery, and you're prepared to pay a higher price to own it right away. The opposite can be said about when it's in contango. That's the norm. I would say almost a normal shaped forward curve, because you have to consider you can buy a commodity today and hold it. That basically means you need to finance. So you need to borrow dollars. That let's just put it into perspective just for clarification, because this is showing the one year spread between the spot and the 12 months further out contract using the commodities that's included in the Bloomberg Commodity Index. If you are buying, let's just take the example, which is actually something like gold, which is the brown line, light brown line in contango. Why is gold in contango? Well, it is because if you're buying gold today, you have to borrow the dollars, and if you borrow dollars for a year, that will cost you 5%. And lo and behold, the contango of 1 year in gold is roughly 5%. So that's really the reflection of the funding cost. So and that goes for all the commodities. On top of that, obviously, you would normally have to pay for storage, which would make the contango even bigger. So a normal market where you have funding costs, you have storage costs, then the forward price should be trading at a higher price, basically in this case meaning contango. The fact that the bulk of these commodities, these are basically the ones out of the 24 commodities in the Bloomberg Commodity Index, are taking those that have a weighting of more than 2.5%. You can see the bulk of these are trading in backwardation, and this is despite the weakness that we're seeing recently. So even though the prompt pricing is selling off, the backwardation has been maintained, and that's that. And you normally say that the spot market it can tell you a lot of story, and sometimes also tell you a few lies, because it's very much also short-term driven, but the curve rarely lies. And right now the curve is telling us that the market remains tight. Many markets remain tight, even though we've had the correction recently. So that's what I'm looking for. And if we take the whole commodity basket together, the Bloomberg Commodity Index, all 24 commodities, and take the weighted roll over a year, then you can see on the blue line we're currently in a small contango. But if you exclude natural gas, which is just crazy, in a crazy contango, then you actually have a small backwardation. And you can see that backwardation started to emerge late 2020 when the vaccine was discovered, or we found the vaccine for the coronavirus. Since then, we saw this very strong recovery in demand for commodities, and the backwardation is very positive for a commodity investment, and that's what I'm showing on slide 7, just to give you an example of what the contango and backwardation means to a passive long investment in an ETF that tracks the Bloomberg Commodity Index. First of all, let's take the period from 2017 to 21. You can see on the previous slide 6 there, that's a period where we were trading in backwardation. What happened to your investment during that 5-year period? Well, if you just looked at the spot prices, all the spot prices, then you would have thought that 5-year period would have given you a return of 53%. But actually, when you take all these rolls into account, basically considering that every month, if you're in contango, when you roll your futures contract, you're selling low, buying high. That's obviously a negative roll. That basically meant that over that 5-year period, instead of making 53%, you actually only made 22%. Fast forward to last year, when we had quite an extreme period of backwardation. again, the spot price last year was would have given you a return around just below 7%. But actually, looking if you were holding an ETF tracking that the Bloomberg Commodities Index, you would have been up 16%, and that's really the benefit of backwardation versus contango. And if we are moving into a future, let's right now minus natural gas, but a future with a continued tight supply, then that will give you an additional return on your investment, and that's I think that's very important from an investment perspective.
Moving on to slide 8, let's talk about energy and crude oil specifically. We were, for months and months, it seemed, struggling and unable, no matter how hard we tried, to get back above the 100-day moving average on the continuation chart. Then all of a sudden, we had this OPEC event where OPEC surprised the market by cutting production. That resulted in a gap up open to take us above the 100-day moving average. And only in the last couple of days, we've come back down and finally tested it. But still, at least as we're talking on Tuesday, we haven't closed that gap yet from the OPEC gap. What do you think? Are we going to close the gap? And when we do, is that going to, reverse the direction and we're going to move back up, or are we headed lower?
Well, that is the almost the $1 million question right now, Eric. Because first of all, when we saw that gap higher, we know that, and again from looking at the cut report, we saw this, and you can see that on the right hand side there. We had two very, 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 very strong weeks of selling when the banking crisis hit, when we broke below 80. I apologize for the American listeners who probably prefer WTI, but I'm a little bit I'm using Brent more and more simply because it's the global benchmarks. But obviously the story is the same. But on the right hand side, I have the combined position of weekly change in WTI and Brent, and as you can see, we had 2 weeks where we had massive amount of selling to the tune of more than 100,000 lots every week. And basically, that meant when that surprise cut came, the market was scrambling to get their shorts covered, and that resulted in especially that first week where the more than close to 150,000 lots were bought. And what we know from the price action, all of that were bought above 83.5, and the fact that we didn't see any follow through in the weeks that followed suddenly left this market very vulnerable to a setback, simply because you're an old trader as well, Eric. You know that if there's one thing that technical traders hate, it's gaps in the market, and that gap was just simply acting as a massive magnet. And then what triggered the eventual break was this continued collapse that we were seeing in refinery margins, which we can talk about on the next slide. But generally, this a lot of this recent action has been explained by the positioning, and the question, as you asked, is what's going to happen now at 80? Are we going to close the gap? Well, I think we probably are, because we're seeing here on Tuesday as we speak, there's a general amount of weakness across markets, some risk adversity creeping in. Stock markets are also coming down, and that means we're probably going to close that gap. And what happens if we see a 77 handle once again, with OPEC having cut production a month ago? They're going to cut again. At least it could start to raise some speculation and some concern. So I think I called in the headline back to the 80s, and I think we were in the 80s during the first quarter, and I think we will probably stay in the 80s for the best part of the second quarter as well. But in the short term, the risk is simply, and that's just referring to slide 9 again with the refinery margins. Right now, refineries margins has collapsed. They're more than half within a relatively short period of time. And that basically means we could start to see refineries cutting back refinery production, and that will lead to lower demand for crude oil, and that could, in the short term at least, send it lower. So I think we're heading for a bit of a troubled couple of weeks here in the markets. Also, simply because there's a lot of built-up expectation that now we're going to straight back to $100. But I think the OPEC reacted to what the rest of the world was seeing. The banking crisis, worries about the demand growth in the second half not living up to expectations. And basically, I would call it a preemptive strike in order to try to maintain prices here in the 80s.
Let's talk a little bit more about these crack spreads and what they mean. A crack spread is essentially a measure of the profit that's made from refining crude oil into refined products and selling them. If you listen to the rhetoric out of the White House, you would think that the way this works is evil oil company executives sit around and say, okay, let's arbitrarily set our prices at a level which is, price gouging and screw the consumer and make big profits for ourselves, as if they're setting the price directly. And President Biden has criticized the industry pretty sharply for setting its prices, and it seems like maybe they're listening now and the prices are coming down. I actually think it's other things besides what President Biden says that determines how crack spreads are resolved in the market. What's your perspective?
Oh, very simple, I would say, supply and demand, and to a certain extent, a certain dose of uncertainty as well. And the uncertainty relates to the sanctions against Russian fuel exports that came into effect early this year. That drove worries about supply shortages, and then that helped drive margins higher. But as we came through that one, and as the sanctions started, and we basically the only thing that changed was ships instead of sailing from the Baltics through the straits around where I live to Rotterdam, they continue to carry through the straits where I live, and now they're heading to India and the Middle East and Asia as well. And so basically the market has not seen a slump in supply, and that basically means that the availability of supply has started to exceed the demand. And I think the canary in the coal mine is the fact that it's actually diesel that has led the slump. What is diesel used for? Well, that's heavy machineries, it's trucks, it's big machines, and that is obviously the engine that drives the economies. And if diesel demand is coming down, that does obviously tell a story about the slowing demand. But you're hinting that you had other reasons, and I think Eric, and I think one of the reasons is also the increased capacity we're seeing in refinery, because initially after the pandemic and the lockdowns, we actually saw some refineries shut down. The market was looking for lower demand going forward. That didn't materialize. So we, I would say during 2022, we had a period of tight production and tight availability, or simply refineries not able to keep up. We're seeing a massive amount of new refinery capacity coming online this year, both in the Middle East. It's becoming a major hub for refineries, but also in India and Asia. And that basically means that over time, the owning refineries is not going to be the big money spinner as it's been in the past. And you can also see, just going back to April 21 and further back, refinery margins tend to be relatively low-key affair. They don't move that much. And I think with the added refinery capacity in the coming years, margins are likely to be under some pressure, because at the end of the day, it's really a question of not demand for crude oil. That's not what you put in your tank in your car. It is the refined products, and if there's competition from refiners to produce that, then there's also available. Then there will be enough availability for the global consumer. But for now, it's sending a bit of a stress signal to refineries, and if we start to see them curb production simply because margins have come down too much, then that will, in the short term, have a negative impact on crude oil demand.
Forgive me for deviating slightly from the slide deck, but there's a question I've been dying to ask you, which is not reflected in the slides, and that pertains to natural gas arbitrage between the United States and Europe. Last summer, a lot of people, smart people, thought, okay, we've finally gotten to the point where natural gas demand in Europe has pushed the price so high that we're going to develop a U.S. export market, and we're going to see a convergence of U.S. and European natural gas prices. So a lot of people thought that U.S. natural gas prices would continue to move higher in order to get closer to European natural gas prices. The opposite happened. Didn't play out at all the way people expected. Is it eventually going to? And if so, is there a trade there?
I was looking at how the market has been behaving, and looking at the increased capacity that's coming online in the US and for LNG export capacity. You would have thought that the global market will become more and more in line, but whether it's going to be at what level, the price level is going to be at, is that it remains to be seen. Because at this point in time, European gas and Asian gas is what, trading around 13 $13 a term, where we are still just hovering above 2 in the US. And it's what makes me just incredibly surprised on a continued basis that that's one of the world's most important and most important energy source of energy can trade so for such a prolonged period of at these very low prices. I suppose part of it is the story is the robust production output from we're seeing from U.S. producers. Some of the gas is produced from oil production, so they have to capture it and almost give it away, and that's adding to supply. Production in the U.S. has remained very robust, even though prices has collapsed. But you would expect that the continued flow to LNG export terminals, which is now around 15 billion cubic feet a day. Back in 19, it was less than half that. So that will obviously be an additional source of supply, which will help bring these prices closer together. But Europe for certain is still incredibly dependent on imports of LNG, and even though it looks fairly rosy right now, we are starting to rebuild inventories, and we may even get them filled up before time. Then we're still only one very cold winter away from an issue, from a problem, and that's where LNG comes in. So yes, I think they will converge, and in order to make it profitable for U.S. producers, they will have to be at a higher level than the $2.20 we're seeing currently. But that's also part of the story that I mentioned earlier with the contango in gas, because when just looking 1 year out, it's a complete different gas price we're looking at. So the market is expecting higher prices in the future, and that's also why it's so incredibly difficult to try to profit on, because the curve is shaped as it is.
Ole, let's move on to slide 10 and copper, which is a subject that I've become even more interested in the last few months. You know, you probably would have done better in copper mining shares than you would have in gold mining shares in the last few years. And frankly, that was before we had the bull argument that we have for copper now. I was fascinated when I interviewed Robert Friedland last. I asked him, hey, Robert, you're in the copper business. You must be excited about this whole electric vehicle revolution and so forth. What do you think of it? And he said, look, we're not excited. We're scared. He says, I know everybody in the mining industry. It's not a question of getting excited about we're going to sell all the copper we can mine. It's a question of we literally don't know where to find anything close to the amount of copper that would be needed to achieve fully the energy transition that's being planned between now and 2050. He's saying there's just not enough copper that can be mined out of Earth's crust in a timely fashion in order to meet that need. Can't be done. Do you agree with that view? Is that just Robert talking his book? Where is this copper thing headed?
Well, I think we just need to look at some of the recent M&A activity in the copper space, and you can just see how mining companies are really trying to increase and beef up their market shares. A lot of recent takeovers and buyouts, and that, I think that's just reflecting a sector where mining companies are exactly thinking that, and looking at the forward projections for demand and how big a share. There's a small insert there which I borrowed from Woodmac and the UBS, just how the percentage of copper demand, how it will continue to move in the direction of the energy transition. So yes, it is a potential troubled future we're heading into. Also, just looking at some big mining companies like Codelco, where they, on several quarters last year, disappointed in terms of their output relative to what they had projected, and they, on a relatively frequent basis, saying it's cost of production, it's lower ore grade, it's lack of water as well in some cases that's driving this or reducing the output. And these are not problems that are going to go away. The low-hanging fruits has been picked years ago, and that basically means we need a lot more material out of the ground to find the metal that's required, and that requires heavy machinery, that requires energy, and that and generally the cost of production will remain high, and prices simply need to be at levels that makes it worthwhile for these mining companies to take the big decisions and go out and look for for the additional copper that is required. So that's a long-term picture, but I think in the short term, copper is quite frustrating. It has been frustrating a lot of investors because these are all known knowns, and but I think it's at the same time also a question of being very patient. If you own mining stocks, by all means, hang on to them and expect there's going to be some volatility on a bumpy road. We saw that recently with a Canadian mining company where suddenly the government in Panama wanted a higher percentage of the revenues, and that led to some problems which then were solved. And we're seeing now also with Chile, where they want to create a state-owned company that wants to have its say in the lithium industry. So there are potential obstacles, but if the end is result is electrified world, and just looking at all the different appliances, it is a king of green metal, copper, simply because it's used in almost all the different applications that the market is focusing on. On the chart here, which is just 1 day old, we've seen a breakdown of that uptrend. That basically means now we're trading back towards the 380 level as we record this. I don't see this as a major stumbling block, but it just highlights again a market where that wants to be long, but then at the same time wants to be cautious if we see some technical developments in the short term. So right now it's still a range bound sideways trading market, but the long term outlook is one of support.
Ole, I'd like to run my personal outlook and trading plan past you, both to share it with our listeners and to get your feedback and scorecard, so to speak. I don't know what's going to happen with commodity prices between now and the recession that I think is going to hit the tape in the second half of 2023. But I think eventually we're going to find ourselves in the depths of a recession, probably back at new stock market lows. When that happens, if I'm right about that outlook, I make the argument that moment is going to be a generational buying opportunity in copper, uranium, and crude oil. And my plan is to wait that out, and when it happens, probably late this year, maybe in early 2024, whenever I feel like, okay, seems like this is the depths of the recession, starting to see bottoming signals in the stock market, that is probably where I'm going to move substantially into copper mining shares, uranium mining shares, and more gold or gold mining shares. What do you think about that strategy, and what would you adjust?
Well, if we came into that situation and the recession becomes as deep and it does trigger a reversal into the extent that you mentioned, then for sure, yes, it does make sense, because you will be looking at these investments as a 5-10 year investment opportunity, simply because of how the world is or the direction the world is moving into. So yeah, I think that's probably a strategy that would work, but it's probably also one that a lot of people are hoping for at this point. If you want to get into the mining, I've been at several conferences recently, and also taking a lot of questions from audience, and it really is a hot topic, and that basically means that there's a lot of focus on it. And I think we just briefly saw last week when the market tried to pop higher, what kind of response it triggered from traders simply worried to miss the boat. So the question is basically if investors are patient enough to wait that long and see whether we can get that correction. But obviously, if we do see a new low in the stock market, then the whole market as a whole, including mining companies, will suffer and create some better opportunities.
Let's move on to gold on page 11. We're almost back up to all-time highs. I'm very excited. I feel like there's a strong bull case to be made here. But hang on a second. Those highs were the 2020 high. Let's think about what happened then. That was the middle of a global pandemic, and the largest pile of printed government money still was, the ink hadn't dried yet on the biggest pile of stimulus money ever printed. Couldn't get above 2080 in that scenario. Then we had nuclear escalation threats, invasion of Ukraine, everything in February of 2022 wasn't enough to get us back even to that level, although we got close to it. So do we need to think about some event pushing us through, or is it just a matter of the underlying economic fundamentals have changed and it's time for gold to move to new all-time highs?
Well, events tend to have as you almost alluded to there, said that tend to have a short-term impact. So it has to be the underlying developments in the economy. We're just now coming up to another potential debt crisis in the U.S. So the debt issue is a global problem and one that raises concerns in general about the stability and so on. So that's one part. But I think my main, or some of my main reasons are still the good old trusted drivers for gold, the dollar and real yields, and we've seen a dislocation. We can see that on slide 12, the dislocation between gold and real yields, and recently also against the dollar, which does indicate that there's been quite a strong pickup in demand for gold, simply because we went from expecting rate hikes to rate cuts within a very short period of time. Those movements in the 2-year and further down interest rates last month was just phenomenal. I haven't seen anything for a long time, and I've been in this market for many years. So I believe that the dollar will continue to weaken. I believe there will be a realignment when the market starts to reprice inflation, not at 2.5%, but maybe 3, maybe even higher, and that will basically drive real yields back down again, and that will help support continued move higher in gold. Then we all know the central bank demand, which has been very strong, a record level last year. I think we may see a bit of a lull here because central bankers are, just like anyone else, are also to a certain extent price sensitive. And when we have a big move in prices we had now for the past few months, then you may just want to feel comfortable with the new level before you continue. But I think the central bank demand will continue to be a force that will underpin the prices, and that's really the main reason why last year at one point gold didn't trade $300-400 low as many were predicting, because if you just look at real yields, but instead actually held up very well. So I think it's not gold going up. Well, looking at the chart where real yields are inverted here on slide 12, it's not gold going down to real yields, it's real yields coming up towards gold, i.e., real yields coming down because of the inversion of the axis there. On top of that, if we do get a recession, then the expectation for rate cuts will increase even further. And right now, as you can see, with the short-term interest rates in the US are pricing in 1.5 plus % increase or reduction between June this year and June next year, and these will help decipher determine the price action in the short term. I think we probably have to be a little bit prepared to that we need to wait a little bit here, because going back to slide 11, I just put in that the impact of peak rates in the US. We've had 3 occasions of peak rates in the past 20 years, and they all led to very strong gains in gold in the months and quarters that followed. And right now the peak is not in. Potentially not in, so we need to wait for that and be a bit patient. So gold right now, I think, is a patient game. We rallied a long way so far. We haven't even corrected 25% of the recent rally. Same goes for silver. So I think we just have to be a little bit patient here.
A lot of us in the commodities space have been focused on the metals because that's where these narratives exist. The narrative about there's going to be an energy transition between now and 2050, and it's going to require an insanely large amount of copper. Okay, copper makes sense. But actually, moving on to slide 13, when I interviewed Lee Gehring, although he's maybe not the common view, he's a very well-researched, knowledgeable guy. He makes the argument that the agricultural commodity narrative is even stronger than the metals narrative in the next few years. And he thinks that we're going to be facing some really serious shortages. Do you concur with that view? And if so, what does it mean for the outlook?
Well, I'll certainly say, first of all, I hope not, because of the impact it will have from a stability perspective. But inventory levels are relatively low following last year. So again, as a World Bank said a few years ago, we only want bad harvest away from a crisis, and I think that's still something that we need to be concerned about. Right now, we are, as I mentioned earlier, a very, very important source of food, stable wheat prices are trending lower. They're very shorted by the speculative community, because the outlook right now there's coming in. We're seeing increased acres in Canada. We're seeing Europe expecting above average production. We still have Russia producing a very robust pace. Ukraine obviously not, but still producing, and that's leading the market to expect that we are going to have another year of we're going to have a year of ample supply, but the weather, the climate change or not, it has become much more volatile, and that's creating a situation there that we should be concerned about. We're seeing that right now in the soft commodities, and that's what I highlighted here on slide 13. That the gains we've seen very strong gains this month so far, and they're all in the soft commodities, and a lot of these gains has been driven by supply worries, sugar exports out of India, Thailand potentially as well, coffee concerns about production in South America. Once again, orange juice in Florida is not going. The production is coming down, and sugar, as an example, we're hitting the highest level since 2011. That's almost gone under the radar. At the same time, sugar, as an example, is also competing with gasoline as a fuel for biofuel production, and that part is also expected to continue to be robust. That raw sugar will be going towards biofuel production instead of to the sweetener, and that will also add some support. So right now, the upside risks are concentrated in softs, but if they do start to switch to the grain sector, which is really the important one, I would say, then we have an issue, and weather is once again what we need to keep a very close eye on over the coming months. So our commodity outlook for higher prices really concentrated on the prospect for higher energy and higher metal prices, and if agriculture start to play its part as well, that would add an accelerator to it.
Well, Ole, I can't thank you enough for a terrific interview. But before I let you go, I want to talk a little bit more about slide 15 and the work that you do at Saxo Bank. A lot of people who are in the stock market space and not really commodities people are not aware of how much of a leader you are, how well recognized you are, but also how much work Saxo does in the commodity space, both on research, trading, and so forth. So tell us a little bit more about it, and what can people expect to find when they tune into your daily podcast? It says here on the slide, if you're not confused, you're not paying attention.
Yeah, exactly. That was a title my colleague John Hardy chose for today's podcast this Tuesday, simply because we were just contemplating all the different factors that was being put into the market, and just basically had concluded that we're confused and the market is generally confused as well with all the different signals that's coming. But the podcast is produced daily in early European hours. We started that during the lockdowns, and it really has been growing from strength to strength. And we are trying to just give our short-term take on equities, forex, and commodities, what we're looking for in the day ahead. That's also what we put out in our daily global market quick take. There's one for Europe, and there's also one created out of Asia from our Asian team during Asian hours. Again, just a very quick list of how we see the world and what's happening, and just to get you ready for the day ahead. And in the commodity space, I do two major weekly ones. My weekly update, which I send out on Fridays, and then the COD update on Monday, and then in between ad hoc updates if there's anything in particular going on that I would like to reflect on. In addition, I try to send out my thoughts as well on Twitter. You can obviously join me there if you want to. It's a great source, I would say, not only to give information but also receive information. I use it a lot.
Ole, we'll look forward to getting you back on the show for an update in a few months. Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at macrovoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, what a great interview with Ole. It was great to have him back. Now, joining us again in this post-game segment is Nick Galarnik. Now, let's get to our chart deck. Listeners, you'll find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Ole's picture that says, looking for the downloads. Okay, let's jump into the chart deck. Eric, on page 2, we have that crude oil. Let's talk about the chart, and also how did the EIA inventory data come in?
Well, Wednesday was a roller coaster day in crude oil markets, with WTI almost touching $78 to the upside early in the Asian session. But the market tanked in the European session to close the 75 spot 60-something OPEC plus price gap on the WTI price chart before the U.S. market even opened on Wednesday morning. Then at 10:30, EIA inventory came in with a great big drawdown of 5.1 million barrels of crude oil. And that was really a 6.1 million barrel drawdown after you consider the million barrels that the Biden administration pilfered out of the SPR again this week. It's the fourth week in a row of drawdowns at a time when they told us they were going to be refilling the SPR at this time. So they're still drawing it down. Cushing, Oklahoma was the only build on the board, building 319,000 barrels. Gasoline drawing down 2.4 million barrels. Distillates drawing down 576,000 barrels. U.S. production ticked back down 100,000 barrels to 12.2 million barrels. Tape action, prices had dropped to fill the OPEC price gap before the data even came out. But then the market really beautifully rallied after inventory, seemingly responding to the bullish inventory draw and showing a convincing reversal after bottoming apparently right below the OPEC plus gap fill price just before the open. But that rally failed right at the crucial 100-day moving average, and then the market really tanked to trade below 74 spot 30 by the close. Supports below the market are at 73 spot 66 and 72 spot 68, and if the latter doesn't hold, it could be new lows. There's really not a lot of support under the market below those levels. So it's going to be really interesting to see what happens next. It is still possible that this was just the shakeout stop clearing run going into Wednesday's close to shake the weak hands out of the market. The people who had just gone long on the gap fill, expecting that that was going to be the bottom with short stops, maybe this was just to shake them out, and we're going to recover from here. But if this market can't get back above the 100-day moving average at about $77 in the next couple of days, then we're probably headed back down toward the lows in the low 70s, if not back into the 60s. So it's going to be really interesting to see what happens next.
Yeah, Eric, when I look at this chart, obviously we had a very big rally through March into the first few weeks of April, and it really came to the top end of the trade range. We now obviously had that full gap fill in retracement. We're about the 50% retracement of the entire rally. And more importantly, we're testing the support line where almost all of the lows were established all the way going back to October of last year, right up until the March breakdown. This is a really important support line, because if we find that oil finds support right in here and this becomes a buy zone and trades back to the top end of the range, then it will continue to support the idea that oil is already establishing a basing formation that may lead to bullish price action in the future. At this stage, will the support line hold is the thing to watch. Now let's move on to the equities. First off, Eric, what are you thinking here on the S&P 500?
I really don't have any strong conviction on equities this week. I don't think the bear market bottom is in yet, and when it does come, I think it's going to be at or below 3,000 on the S&P. Last week, I was leaning toward the market melting up to 4,300 before rolling over to the downside. Needless to say, this past week makes it look like it already rolled over and the bear market is already back on. But as of the time of recording, we were just above must-hold supports. So if this is just a correction, it should end here. If the selling continues below this level, then my 4,300 projection will be thrown out the window and the downside target is 3,000 by year end or maybe early in 2024.
Yeah, Eric, that 4,300 is pretty important. I think it's a level that could still be arguably tested as we move forward. On page 3, though, we have the S&P 500 support resistance levels. Now, Nick, what are you watching and what are the options market telling you?
Spot right now is 40.60 approximately on SPX. So we have a call wall above at 4,300 and a put wall below at 4,000, which is also very, very heavy support. The implied move for the May 19th OPEX, again, keep in mind that next week we have FOMC on Wednesday, which should be a volatility-inducing event, is 120 points in either direction. So from the current price of 40.60 or so, we have an upside expected move of 41.80 approximately. Keep in mind 4,200 is also heavy resistance. And on the downside, we have 39.40 as a lower expected move. Keep in mind, again, we have support at 40.50 and 4,000 yesterday, for example, we tested out the 40-50 area numerous times in the last hour or so, kept bouncing. We broke below it temporarily and then boosted above it into close. So that level's held pretty strongly. Again, I mentioned last week that I think we're going to see more volatility pick up after the April OPEX. And already thus far this week, we've seen a larger range in the first 3 days of the week than we had in the previous 2-3 weeks or so. So going forward, again, I'm getting more bearish as we push forward, but that doesn't rule out the possibility of a push to the upside of like 4180, 4200 area, perhaps. It really is in the hands of the Fed next week.
Yeah, I agree with you, Nick. When we look on page 4, I put that overhead resistance at 4,200 where we rejected. But this entire correction so far has only just come back to retest the 50-day moving average. It hasn't even done a 50% retracement yet of the prior rise. There is no evidence that the bulls have at least yet dropped the ball. At this moment, if the bulls hold the line, and particularly like you're saying with that important put wall down at 4,000. Arguably, if the bulls just can keep this north of 4,000 throughout a 1 week correction, that could result in a bullish impulse that could easily see the S&P retest those 4,200 highs and or head toward that level, Eric, that you were talking about near 4,300. But what I wanted to highlight here was on page 5, I put the S&P 500 equal weight index ETF. And what's interesting is while the S&P 500 like the NASDAQ has been generally demonstrating strength, it really has come on the back of just a few mega cap stocks that have been doing incredibly well. Once you look at all of the S&P 500 stocks equally weighted, the rally has over the last month been incredibly weak. The S&P 500 equal weight index hasn't even made back 50% of the losses that incurred through the February-March drop. And so it just really shows you how thin that market breadth is and how reliant this market is on the continuation of those real big leadership names.
Yeah, Patrick, as I mentioned last week, we have roughly 20 companies that have carried about 90% of the gains on the S&P over the past few months or so. And, as we saw yesterday, for example, Microsoft was up about 8% after a solid earning report. Google was pretty much flat after, I would say, a so-so earning report. Today we have Meta, which beat earnings last night. They're up about 10% or so. So you have a few names that are carrying the overall market because of the sheer size of them, right? You have these trillion-dollar companies like Microsoft, Amazon, Apple, for example, that are carrying the market higher. And you have the majority of companies that are kind of stagnating. So if a lot of people that are watching this show see that we have names in your portfolios that haven't moved at all or even slightly down, the reason being, you might be wondering, is that it's the Apples, the Amazons, the Metas that have been carrying the market higher.
Right. And, and that really has also been what has created that outperformance in the NASDAQ in general. So on page 6, we have the QQQs. And yeah, they've held up. I mean, they've corrected here in the last little bit, but overall continues to show relative strength. And we'll talk about it in a second, but let's start off just with the levels that you're watching.
The spot right now is 314 approximately. There's a call wall above at 330, a put wall below at 280. The implied move for the May OPEX, again, is $12 or so in either direction. So the upside expected move is around 326 with key resistance above at 320. And the lower expected move is 302 approximately with key support at 300. Now, keep in mind, we have Intel earnings and Amazon earnings today after the bell. And then next week we have AMD, Airbnb, and then most notably Qualcomm and Apple, especially next Thursday, May the 4th, after the FOMC event.
Nick, what I wanted to talk about here on page 7, I put that Russell, and we haven't followed small caps too much on these talking charts, but it's just amazing to see how weak the small cap space has been. Now, in fairness, the small cap index does have a lot of regional banks in them, which have been the worst performing sector, obviously, because of the regional bank crisis, which has been a drag on this. But it does show that real issue with broad market breadth. There simply is not any significant strength in stocks outside of those big mega caps that you talked about. And it really is most evident on page 8, where I have the Russell over the NASDAQ. And it just goes to show that the Russell continues, it's almost at a fresh new low in terms of this factor analysis of just looking at the fact that the NASDAQ it has to pretty much continue to demonstrate this strength in order for the current markets to hold up, or we would have to see some catalyst emerge that would broaden the breadth of the market and cause a much stronger rally. Will the Fed next week be that catalyst? That's certainly the thing to watch.
That's a good point overall, Patrick. Like one thing I just thought about right there was that most of these small cap companies are not very well capitalized, and with higher interest rate environments, it makes the probability, or rather increases the probability of them failing much, much higher, and therefore makes them much, much riskier investments. So that could be a reason why we're seeing a flight into safety, safer names of Microsofts, Apples, Googles that are well capitalized versus these small cap stocks.
All right, let's move on to page 9, where I have that volatility index. And what was surprising is we had that really sharp drop in volatility. And while the VIX was down to like the 17-16 handle on the downside, daily volatility implies were single digit at one point the other week, until this little market drop suddenly brought volatility back. Do you think that we're going to normalize back up near the 20 level, or do you think we can stay down here in the lower teens?
I think we're going to stay suppressed for a while, especially if the FOMC event is a nothing burger event. What I've noticed, though, the past few months, notwithstanding the Silicon Valley Bank collapse, is that what happens is that after the monthly OPEX each month, we tend to see a volatility spike temporarily, and then we regress back down into the following OPEX, right? So, for example, last week we were very, very muted. The week before we were very, very muted as well in terms of movement. This week already we've seen a lot of volatility, but that should regress as we approach the May 19th monthly OPEX as well. So I expect that we'll stay below 20, but again, anything can happen. There's rumors that another bank could fail, perhaps one of the small regional banks. And if that does happen, then, that could cause another leg down perhaps. And if we get below that 4,000 level on the SPX, then look out below.
All right, guys, let's move on to the US dollar index on page 10. What are you thinking here on the dollar, Eric?
The dollar's consolidation at the low end of the trading zone has steadied now, and it could last a while. A close over 105 or below 100 is needed before a new directional trend can be declared. So until that happens, we're officially holding steady and waiting for the next shoe to drop. More and more notables are predicting that the next shoe to drop could be a sharp move lower on the dollar. But despite that view's increasing popularity, it hasn't happened yet.
That dollar index does continue to hold along those previous lows at 101, but what really will decide this is all of the central bank news that we're going to be getting in the next week, starting with the Bank of Japan here, the ECB, and the FOMC all within a week. And really, I think that may determine whether or not the dollar has another leg lower or whether or not the trade range prevails. At this stage, even a very short-term break of the 101 level, long as it gets back into that trade range, we could see the dollar continue to bounce around in this 101 to 105 level. But let's see whether or not the central banks start moving this market or not.
Now, guys, on page 11 here, we have this chart of the gold futures. What are you guys thinking here?
Little change from last week. The market is stuck between round number support at 2,000 and overhead resistance between 2060 and 2080, the latter of which, of course, was the all-time high for gold. My prediction is that we will eventually get to new all-time highs before this bull market is over, but not right away. This is a pretty formidable resistance level. We've come a long way very quickly. It's time for the market to consolidate a little bit before it breaks through this level. So I'm watching for a close below 2,000 to start a rout. Looked like we started to have that. We had one close, I think, below 2,000, and then Wednesday was closing back above. And as I'm recording right now, I'm looking at 1998 on the June contract. So we're holding right around that 2,000 support level. My guess is that is going to fail. We're going to get a correction lower. How much lower, I don't know. But eventually, I do think that we'll break out to new all-time highs.
My view overall is that gold has been benefiting from that US dollar weakness in general. And obviously, with all these central banks coming out, we're going to get a potential currency move. I think gold will, on first reaction, move inversely to what the dollar is doing. I still think technically this is a bull trend, and there's nothing stopping gold from taking another stab on the upside, maybe punching 2,100 on an advance. But overall, I think that the dollar will decide whether or not this breaks to all-time highs and sticks to it, or whether or not we mean revert back to 1900. Nonetheless, I wanted to just finally look at the copper chart on page 12. And even up to last week, when it was holding above $4 and making higher highs and higher lows, there was still some sort of flows that gave copper a chance to have some sort of a bull breakout. With the recent weakness and the breakdown below $4 down toward the March lows here, at minimum, we just really have a copper market that's inactive. It doesn't mean it's going to be outright bearish, but clearly no new bull cycle is underway yet. And we're certainly going to watch how long this consolidation and trade range prevails. I still think that it resolves itself bullishly, but we're just going to need to see a little bit more price action. Maybe it's going to be a second half of the year story.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, tell them what they can expect to find in this week's Research Roundup.
In this week's Research Roundup, you're going to find the transcript for today's interview, as well as a link to the slides that Ole Hansen provided, as well as this chart book we just discussed here in the Postgame. There's also a link to a number of articles that we found very interesting. So you'll find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @EricSTownsend. That is Eric spelled with a K, and follow Patrick @PatrickSeresna. On behalf of Eric Townsend, Patrick Seresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.